Good evening, everyone. A very warm welcome to each one of you who has joined us today for this informative webinar hosted by the South Indian Bank Limited. My name is Anne and will be your host for this webinar today. Today's session focuses on a topic that holds immense relevance for our global Indian community. Do NRIs need to pay income tax in India? With changing tax regulations and increasing global financial integration, it is important for NRIs to clearly understand when and how Indian tax laws apply to them, whether it's income earned in India, rental income, capital gains, or investments. This session is designed to demystify the tax obligations of NRIs and help you stay compliant while optimizing your financial decisions. We have with us Mr. Sreejith Kuniyil, renowned tax consultant and expert in NRI taxation, who will guide us through the key rules, exemptions, and updates that you need to be aware of. Mr. Kuniyil, who is a self-made entrepreneur, renowned chartered accountant, and accomplished business mentor with over 23 years of experience in consulting and advisory services, is the CEO and founder of PravasiTax Solutions Pvt Ltd. He is widely recognized as a trusted business and wealth advisor to several leading enterprises across Kerala. In 2020, he founded PravasiTax, a hybrid tax advisory platform designed to deliver tailor-made tax consulting services to non-resident Indians across the globe. Beyond his core professional expertise, Mr. Kuniyil is a dedicated career guidance expert and business coach. Through his platform FinTech's Man, he conducts master classes that empower entrepreneurs and business owners with practical insights and strategies for success. He is also the visionary behind Special 40, a revolutionary job-oriented upskilling program crafted specifically for commerce graduates aimed at enhancing their employability and industry readiness. Sir, we are truly privileged to have you with us today. Before moving on to the session, I invite Mr. Prashant Tadagan, Assistant General Manager and Head NR, South Indian Bank, to give the welcome address and officially commence the session. Over to you, Prashant, sir.
Hi. Thank you, Anne. Thank you for that wonderful intro. Good evening to everyone. It gives me immense pleasure to welcome each one of you to today's special webinar hosted exclusively for our esteemed NRI customers. So, on behalf of South Indian Bank, I extend a heartfelt welcome to all of you for joining us from different parts of the world. We truly value your trust, association, and continued interest in staying connected with India. So this session is part of our ongoing commitment to keeping you informed, engaged, and supported. So I take this opportunity to welcome Sreejith sir to this session. Thank you for accepting our invite and taking out your time to address our customers. So we welcome you, sir. Over to you.
Thank you, sir. Thank you, Prashant. Thank you so much. I'm audible, right?
Yeah, we can hear you, sir.
Sir, thank you, Prashant, sir. Your igniting words have set the tone of the event. Before we begin, here are a few guidelines to be kept in mind. Please note that your microphones will be in mute by default. If you have any questions at any point of the session, feel free to drop them in the chat box, or you may use the raise hand feature to ask your questions directly. We will address them during the Q&A session at the end. Coming to the chat box, so you can just open the chat box. Kindly click everyone, then select Manas V, who is a co-host of this webinar. You can type your questions and in his inbox so that these queries will be addressed. Now over to you, sir. We are waiting for your session. Thank you.
Thank you so much. Thank you so much. And it's my pleasure to take session for South Indian Bank. And personally, I have but South Indian Bank is my personal bank as well, though I have I use other banks for my corporate thing. But last 35 years, actually, I've been using South Indian Bank as my banker. And thank you so much. And I have personally obliged to do a session for South Indian Bank for their NRI customers. Take this topic for today is do NRIs need to pay tax in India? That's a major NRIs have a kind of a doubtful scenarios whether why a NRI should pay tax in India. This is a topic I've been last 5 years. I'm advocating the whole NRI community in across the globe, and from 2020 onwards, after COVID time, I think I might have conducted more than 80 plus sessions so far in last 5 years. One important concept I just want to highlight to every NRI customers: if you have any investments in India which generates income, then you should definitely you have a little bit of tax knowledge. Little bit. I won't say that you should be an expert in tax, but always a little bit of tax knowledge is something required, especially from the NRIs from the Gulf regions, because you are not subject to pay tax in the Gulf region. But eventually, what happened? All your wealth, what you created over a period of time, you invest in different forms in India, and then technically, one day you are answerable. And I would say that people always worry about tax, but I always say that you don't need to worry about tax. It's all about you should know about tax. There are two conceptual thought process. Otherwise, hardly complying in the tax procedures in our country is actually when it's a normal procedure. It's like a normal procedures. That's something just want to give you a little bit of comfortness about income tax. Otherwise, always everybody has a kind of a worry part on the income tax front. Anyway, let's start the topic. Why NRI need to pay income tax in India? In a country like such a large population with 143 crore people, so you can just check how many people actually pay and file tax return. So around 7.65 crores people only file tax return, and out of which only 2.23 crore people only pay income tax. So when I say pay income tax, it's not large income tax. I'm saying you would say that even 80% people only show income less than 10 lakh rupees to the India. So that is a kind of such a fourth largest economy like in India. You can see only 2.23 crores only people pay income tax in the country. So that's definitely would be a key government, and that's exactly the reason Indian government also took a few major steps. As you all know, that demonetization came, and I always say that after 2017, the whole Indian tax system has been completely changed after demonetization came in the country. Then you have cash restrictions introduced. For example, any real estate property purchase and sale more than 20,000 rupees cash is not allowed in the country, and any giving or accepting loans more than 20,000 rupees also not allowed in cash, not allowed in the country. Any transaction more than 2 lakh rupees actually banned in our country. See, if you can see all this transaction along with even GST came in 2017. And when you withdraw cash from the bank, again, there was TDS was introduced, section 194N. And so recently, as you all know, that 2000 rupees notes also been banned. So with all these measurement, you can see it started something called Project Insight, which was a very large uh, concept was started in 2017. So Project Insight is actually a project of the Indian government to capture the tax systems. So what is Project Insight? Just give you a brief background on how income tax department is actually been developed this Project Insight. There is a reporting portal. What is a reporting portal in India? From India, there are financial institutions like banks, post office, financial institutions, NBFC, stock exchange. They report to the income tax department. From outside India, income tax department collect the document from the outside India. Also report there's something called um, um, foreign asset investigation unit. We call it an FAIU. It's a separate department. It's actually functioning in different parts of the world. So they are collecting the documents, informations from outside the country, and also reports. So all those transactions being reported to the income tax portal. That is back end. It's happening. Then front end, it's basically what all like you all individual taxpayers. What we see is basically a compliance portal. When we log in income tax portal, we see the front image of the mirror, which is a compliance portal where you can see all those transactions like annual information system, SFT, campaign query, all those transactions is actually the result of those the backend reporting portal being functioned and operated by the income tax department and collecting the documents from the different other banking and financial institutions. This is a concept of a project insight. Now, I just want to highlight the concept of income tax, how it works in our country. Income tax is a self-assessment tax. What is self-assessment tax is basically you assess your income at your individual capacity, then you offer to the tax to the government. For example, in our countries, it's financial year. It's start from April to March. Once you complete the April to March financial year, now you need to assess your total income which was earned in that particular financial year. Now you offer to that particular income to the government. That's something. For example, by August September time, you pay the income tax to the country. When you have an option to a self assessment, when you voluntarily offer the income tax to the government, so always there is a challenge. What I earn is I supposed to offer. So there is always a comparative analysis. Basically, whatever I earn, should I offer to the income to the government? So this is exactly the difference. I always ask this question: why a person earn an income? Why a individual need an income is basically to have a good quality of life. When you are thinking about a good quality of life, where is the quality of life of an individual goes? See, we always earn income and wealth, and we do investments in different forms of assets like real estate, stock markets, term deposits, insurance, social security investments, right? Then you'll have a good lifestyle expenditure, good quality of life, like your foreign travel, maybe a business class trip or a jewelry, bullion, vehicle, diamond, white goods, home appliances. See, an individual who earn income and wealth, he always either invest in these formats of assets or he incur these type of a lifestyle expenditure. Okay, this is a typically kind of a combination of investments and expenditure of a wealthy individual or a somebody who is earning a good income capacity. So as you spend, government also knows your quality of life. That's the reason if you see last 6 7 years, they have shifted the focus from income to expenditure investments. You see all those income tax notices, inquiry you receive, it's always been relating to your expenditure investments. They never challenge, they never question your reported income is a underreported or overreported. Nobody can challenge your income. Nobody will get any shock of notice by saying that you only offered 2 crore as an income. We understand you earned 3.5 crore as an income. That never come into the scenario. Always they said, we noticed you incurred these expenditure, these investments. We couldn't find a track corresponding income in your income tax return. That's always be the question for the income tax side. So now let's see how and from where income tax department get these high value transactions. Of course, when you deposit cash more than 10 lakhs in a year in aggregate, when you incur credit card payments worth more than 10 lakh rupees in a year, if you incur 1 lakh rupees in cash, purchase of shares and mutual fund more than 10 lakh rupees, purchase or sale of property for more than 30 lakh rupees, term deposits, including renewal of an NRE deposits if it is more than 10 lakh rupees. So all these transactions, income tax department get information from the banks and financial institutions. And other data, banks and cooperative banks, they reports interest, corporate, they reports dividend, stock exchange, they report capital gain transactions. If you see all your investments, all your income relating to passive income is income tax department get the information. One more information income tax department get, if you buy any luxury goods for more than 10 lakh rupees, they get TCS 1% on the luxury goods. These information also government collects. Motor vehicle, home theater, all your lifestyle expenditure, you can see this is a recent notification came in 22nd April 2025. Earlier, motor vehicle was in the list. Now they have added the other luxury goods as well under the TCS scope of 1%. So just want to highlight TCS is not income tax, which is just kind of a mechanism to measure how and what all luxury goods are you are purchasing. That's just tracking the mechanism of your expenditure side. Wristwatch, sunglasses, handbags, purse, shoes. I don't know whether how many of you buy for more than 10 lakhs worth of wristwatch in India. I'm talking all these transactions happening in India. There is an additional TCS of 1% also they collect. Now the question is, you don't need to pay tax. The only question you need to answer whether you really earned 10 lakh rupees and offered that 10 lakh rupees as an income before you purchase 10 lakh worth of wristwatch. So they started comparing your income with your lifestyle expenditure and your investment side. So let's see now all this information relating to investment expenditure already been tracked. Now the question is how they follow this information, how they process this information from the income tax perspective. Let's see. First you get e-campaign query. There's something called e-campaign query. Once you get an e-campaign query, you have two responses you're supposed to give. First response is whether these transactions, these information belongs to you. Second feedback you need to give whether this information already been reflected in your IT return. These are the two information you're supposed to give in the e-campaign query. Initially, they will start with query. If you don't respond to the query, then it become a notice, which is called a e-verification scheme notice under section 133 subsection 6. So in the e-verification scheme, you get little more additional information you need to provide with the supporting evidence for all those transactions, what they have reported. Once they verify with the e-campaign e-verification, then still they believe there was a instance, there was this transactions was missed to offer to the income tax. Now you receive another notice under section 148A, which is basically your assessment notice, income tax notice. They believe this particular income was escaped for assessment within the meaning of section 147. Then technically this particular notice of 148A open for inquiry. They need little more information. So that exactly the assessment procedure starts. If you didn't give a proper explanation, if you didn't give a proper inquiry response, automatically this become an assessment order under section 148. So this is how the typically the transaction happen. In case you have foreign accounts and investments, there is a possibility you may receive summons as well. For example, we see a lot of insurance, foreign insurances, they take it from Bahrain, and many NRIs have received notice for summons for those foreign insurance transactions. One reason they didn't file IT return, and the other reasons they might have filed IT return as a resident capacity with an ITR1, then also they may receive summons. This is a summons. They may even ask you to provide your banking details in the other country. So I can just give you a few real-time scenarios, few of our clients, just namesake, just give a reference, country, name, don't connect to any person, but cases are real cases. Okay. What happened? As I said, you may receive e-campaign query, you may receive a e-verification notice, and you may receive a 148A notice. Still, if you don't respond, what's going to happen to your assessment? In one case of an SSE who was a resident in 2010, he moved 2012, he moved to Kuwait. Then a property he bought for 1 crore in 2015. 2019, he received 3 notices from the income tax department to file return within the due dates. He didn't submit any response. The reason he didn't have a notice, such a notice was actually being sent to his personal email. Hardly very few people actually been check their personal emails today. Most of the personal emails actually been bombarded with your promotional mails and other banking transactions. So please do closely monitor your personal emails. Sometimes there could be a possibility you may receive the income tax notice as well in the personal email. I would always recommend, as I already mentioned a few transactions earlier, right, with that kind of value. If you have done any such a transactions after 20, I would say that 2019 onwards, 2019 onwards, you can go back to your income tax portal and cross check if any transaction was already been reported in the form of a campaign query or a campaign notice. The consequences, what happened? They treated this assessee as a resident, and the whole investment in the property as considered as income, and penalty proceedings also initiated. Around 85 lakhs came as tax plus demand. So imagine 2015 he bought a property for 1 crore, and eventually what happened? It became a income tax liability of 85 lakhs. That is a one case scenario. Another scenario, a NRI who booked FD for 2.5 crore, he didn't file any return. He received a 148 notice to prove the source of income. Though he filed a response very vaguely, he responds, and he didn't submit much of other information. So income tax department passed the whole 2.48 crore FD as unexplained income. 60% tax levied on as unexplained income. Penalty proceedings has been initiated. You might be wondering how a 60% tax comes into the picture. There is something called punitive tax, PUNITIVE, punitive tax, section 68, section 69 is there are quite a lot of few sections in the income tax law which considered as penalty taxes. That is the reason it's called punitive tax. The tax rate starts from 60, then surcharge and surcharge and cess all put together it comes around 74% tax. So this is something they take it very seriously. If you don't have an explanation for an income, if you don't have any explanation for your investments, they consider it as a little bit of weak such transaction. That is the reason this tax rates may come. So that is the reason always I ensure, always please ensure keep your supporting documents, keep your proof of source of income, keep your documentation in place. At least always keep it for last 5 years, always. So that's something I have a personal request to every NRI who attend this session. So please ensure your foreign bank statements are in place and all your source of income is credited to your foreign bank statements being reflected in the form of a proper supporting documents. So, okay, I didn't show this part, right? So 2.5 crore is converted into 4.15 crore as an income tax demand. It's a real case. Okay, we are handling this particular case in office. I'm just giving the kind of how serious these matters of compliances in India. So every NRI is believe I have only NRE account in the country and all NRE accounts are exempt from tax in India, then why should I worry? This is a common thought process every NRI under impression. It's a completely wrong understanding. NRE account is not an exempt from tax. That is a fundamental difference I just want to highlight. NRE account is also subject to tax. I'll explain how it happens. The interest income from the NRE account is exempted. And that means if any interest earned on an NRE account is exempted, Section 10, subsection 4, subclause 2 of the Income Tax Act is giving you an exemption on the interest on the NRE account, provided you qualify to be an NRI under FEMA. There is another act called Foreign Exchange Management Act, which is FEMA. FEMA is giving you that benefit of taxation under the Income Tax Act. So this is a conditional exemption. It is not a permanent exemption. It is a conditional exemption. So as long as you keep your NRI status under a FEMA, then only you retain your interest exemption status on the NRI account. Then foreign source of income is also exempted. Having said, if your NRE account received any Indian source of income which is taxable. Now the second question comes, how come an Indian source income get credit in an NRE account? I just give you a simple example. Assume you have a property in Chennai and you NRI, both NRIs are in Dubai, and the first person you may inquire to buy that particular property, you want to sell the property, you will inquire among your friend circle. Assume your other friend in Dubai agreed to buy the property in Chennai, then automatically what happened? The transaction can happen either from your Dubai account and also from your NRE account to NRE account. So since the money is received from another NRI to your NRI account, that doesn't mean it is exempted for the income tax purpose. Still, it is subject to income tax. That is the reason if you see any income tax assessment inquiry being initiated on any NRI, they're supposed to provide their NRE account details as well to the income tax department. So that just giving you a highlight doesn't mean if you receive any income in from your NRE account, it is exempt from the income tax purpose. So this is something I just want to highlight. NRE account is also subject to income tax scrutiny. So now let's see what all those incomes is going to be taxable in India. So your interest income from the NRO account is taxable. NRE interest is not taxable as I explained earlier. Your rental income is taxable. Your share trading income is taxable. Your income from your property sale is taxable. Income from the property sale, not your sale consideration. Your any income you received from a business or profession also taxable. So just want to highlight, irrespective of your residential status, even a US citizen also subject to tax in India if you receive these nature of income from India. So India follow a territory and residential basis taxes. So all those income is earned by any individual, any residential status guy, any citizen. He also subject to pay income tax in India if you earn any income from India. This is just a basic thumb rule. Let's see what are the tax rates here. The financial year 25-26 financial individual tax rates is, there is something called old regime and there is a new regime. Under the old regime, to 2.5 lakhs it is nil, and 2.5 lakhs to 5 lakhs it is 5%, 5 to 10 lakhs it is 20%, above 10 lakhs it is 30%. So once somebody want to claim a tax deduction under Chapter 6A, I'll explain what are Chapter 6A deductions, like your LIC premium, your house property premium, then your Mediclaim policy and your donations. All those deductions are comes under the Chapter 6A. Those deductions are available if you want to claim, and also you will fall under the old regime, tax regime, which is start from 2.5 to 5, 5 to 10, 10 above. So that's the rates. But now this is not the regime most of them will follow. I would say that 90% individual taxpayers comes into the new tax regime, which is a very, very attractive tax regime, which is introduced in last year. For an individual level, I would say that India follow a very, very low personal tax compared with other developed nations. Up to 4 lakhs, there is no tax. 4 to 8 lakhs, 5%. 8 to 12 lakhs, it is 10%. 12 to 16, it is 15%. 16 to 20 is 20%. 20 lakhs to 24 lakhs, it is 25%. And above 24 lakhs, it is 30%. Simple mechanism is 4 lakhs. Every 4 lakhs, there is an incremental 5% tax rate comes to the picture. But Chapter 6A deductions are not available. That means somebody wants to claim a Chapter 6A deductions, you need to follow the old regime. And somebody ignoring the Chapter 6A deductions, you should follow the new regime. Eventually you end up in following new regime only because this is a very one of the attractive tax individual slab rates. How it works, I will tell you. Assume you have interest income and you have a rental income and you earn only the total income is 3.5 lakhs or 4 lakhs. That means you are not supposed to pay any tax in India. You are completely tax free person, and also you don't need to file income tax return also. up to 4 lakhs, there is no need to file IT return, and also there is no need to file there is no need to pay income tax, since there is no filing also requirement is in India. Now, how it works in other way, I'll explain. This is for NRI. Quite a lot of most of the individual laws, we heard up to 12 lakhs there is no tax in India. Yes, up to 12 lakhs there is no tax in India, but unfortunately that's applicable only for resident, not for NRI. That means if an NRI income is in the range of 4 to 8 lakhs or 8 to 12 lakhs range, he is still required to pay income tax in India, not eligible to claim rebate. We call as a 87 section 87A rebate, that's available only for resident, not for an NRI. Now let's see who is mandatory to file IT return in India. If any individual who wants to claim tax deductions on Chapter 6A, that means comes under the old regime, is income, taxable income exceeds 2.5 lakhs, he is supposed to file IT return. Assume another individual, no tax deduction available, he believe his taxable income may exceeds 4 lakh, then only he need to file IT return. That is the mandatory condition for filing IT return. Any individual who travel in a foreign country and incur 2 lakh rupees, he also required to mandatory file IT return. Any individual who incur electricity bill for more than 1 lakh in a year, that means 8,333 per month, he also required to file IT return. If you do any deposits, cash deposits in any bank, NRO or resident account that exceeds 50 lakhs in a year in aggregate, it is mandatory you file IT return. Again, very, very important. This is something most NRIs may miss out. TDS and TCS, if it cross 25,000 rupees in a financial year, it is mandatory. Just give you an example. For an instance, say for example, an NRI who earn dividend income or a short-term capital gain, both scenario that will be a TDS. And when we ask, sir, please file IT return, he may say that why should I file IT return? Anyway, there is no refund on this TDS. But technically, in case his TDS is exceeded 25,000 rupees, it is mandatory that he should file. It's not a wish whether I should file or not. It is a mandatory. Mandatory means if you don't file, there are other consequences. Having said conditions, but I still recommend every NRI, whoever had done previous years investments and such a high value expenditure, file IT return. Other benefits also available by filing an IT return in India. Your TDS and TCS become a refundable amount. I will explain how TDS and TCS become a refundable. Then if you incur any loss in your share trading, that loss can be carried forward to future years. You want to prove your NRI status, the only document that you become NRI, your civil ID and your residency permit won't consider to prove an NRI status in India, and also your NRI account also won't prove your NRI status in India. And you want to do any visa processing in US and UK and Canada from India, IT return is a mandatory document. And as I said, there is a TDS on cash withdrawal. Assume if you are an individual been filing tax return for more than three years in India, then the 25 lakh slab has been increased to 1 crore. Then you want to apply any bank loan and you want to get an admission under the NRI quota for education, IT return is a document mandatory. And term policy, you want to take it from an insurance company in India. Once you're back in India, then again IT return is also a document to prove. Want to participate in any government tenders under the NRI capacity, again, IT return is a mandatory document. Having said, once you've been filing a return on frequent times, getting income tax notice, I would say no, but still chance is remote. if you are a tax, if you are a continuously been filing IT return in India. These are the benefits of filing an income tax return. Now, I'll just explain 31st July 2025 it was the normal due date. Now it's been extended to 15th September 2025. Lots of development, lots of backend system is being update is happening. So we expect lots of developments comes on the transaction or tracking the transactions of an individual level. That's the reason why this year the due date has been almost 1.5 months extension has been granted for individual taxpayers. In case you missed to file IT return before 15th September, you have the last chance is 31st December 2025. And also I remind you, once you missed the bus on 31st December 2025, practically it is not possible to file IT return for financial year 24-25. So keep these dates in mind. And now, still the IT return portal is open. You can either file before 15th September or after 31st December with fine. So consequences, loss cannot be carried forward. There is a possibility you may receive a campaign query for non-filing if you have done any transactions, and there is a late filing 5,000 rupees, and there will be interest for delaying in filing returns. So these are the consequences for filing the belated return. So people ask what happens if I don't file a return. So in my last 25 years experience as a consultant, being a tax friend, I never seen income tax department started taking criminal proceedings against non-tax filers. But this is something very shocking which happened on 14th March 2024. A Delhi woman was sentenced for 6 months jail for not filing an income tax. Though she received the bail, but I will tell you, this is something government is taking very seriously. So that is the reason. Don't take it on a chance if you are any such kind of a income tax payable requirement or a filing requirement in India. So now very important topic I'm going to cover it, which is TDS, tax deducted at source, and many people might know, but I just still definitely bank customers definitely know about what is TDS. I just want to highlight TDS two different thought process. TDS is not income tax. That is a fundamental thought process you should have. TDS is not income tax. Most of the people believe, why should I pay income tax since bank already deducted TDS? TDS is just a mechanism introduced by the government to collect the tax on a regular intervals. So what is regular intervals? Everybody need income on a regular interval so that you meet all your expenditure. Similarly, government also need regular, because tax is their income. So they also need income at a regular interval so that they can also meet their expenditure. That is just a mechanism introduced as TDS. So TDS is not your final income tax. This is just kind of a regularly whoever is paying that income from the direct payer level, they ask them to deduct X percentage when before they pay making the payment to the recipient, the income order. So that's like a mechanism introduced by the government. I'll explain how it impacts NRIs. So you earn interest income from bank, that interest income from the NRO account, which is TDS, is 30%. This is a very wrong understanding of every NRI. They believe NRI's income is subject to 30%. That is not the case. NRI's TDS rate is 30% on the interest income. Your income tax rate in India at slab rate very similar like a resident. There is nothing extra NRA pay in India better than or maybe I would say worse than a resident in India. So your TDS rate is 30%, but your tax rate is slab rate. That means up to 4 lakhs no tax, 4 to 8 5%, 8 to 12 10%. That 4 lakhs slab rate will fall. That is a one basic understanding you should have. Then the rental income, again TDS rate is 30%. That means that doesn't mean you pay 30% income tax. Your rental income again subject to slab rate. Long-term capital gain, it is 12.5 percentage. Now, earlier it was 20%, now reduced to 12.5 percentage. 12.5% you get exemption of 1.25 lakhs. So that means up to 1.25 lakhs of your long-term capital gain, there is no tax. In case if your long-term capital gain exceeds 1.25 lakh, then only your 12.5% tax comes to the picture. Short-term capital gain is 20%, 20%. That means TDS rate is 20%, your final income tax rate also 20%. Dividend again, 20% is the TDS rate and tax rate is 20%. You see, last two bottom line item, all other three above are subject to refund. I'll tell you, most of the case we have seen in our cases in last 4 5 years, every NRI comes into the kind of a refundable scenario. Whoever is earning only the interest income or rental income or a long-term capital gain scenarios, because most of the people ignore only reason they believe this is a TDS rate already been paid to the government. Why should I get into the filing scenario? Why should I get into the compliances in India so that well, in future I may have any problem? So don't worry, okay? Please file a return, claim the refund. I'll tell you earlier. I've been shown you around 7 crore people. Um, 7 crore people only file tax return out of 140. Now, technically, around 9 crore people's TDS has been deducted. Out of 9 crore people, only 7.5 crore only people are only filing IT return. That means around 2.5 crore are not even filing IT return to claim the TDS. So the moment you lose the benefit, you miss the date of 31st December or 15th of September, practically it is impossible to collect the TDS due from the government. It is impossible. So better file IT return so that you can claim it refund back. That's one thing. Now the question is whether is there any possibility that TDS rates can be reduced. Of course, there is a possibility on the interest income. Yes, interest income there is a possibility, and also dividend also there is a possibility. There is something called double taxation avoidance agreement. We call it as a tax treaty, or you can apply lower deduction certificate from the income tax department. So this is something. Nigeria, okay. Of course, India has signed treaty with the more than 75 plus countries, and including all the GCC country except Bahrain, and few countries there is no tax treaty, but otherwise most of the country India has a tax treaty. Nigeria is one of those country, and in case rental income and interest or a property sale, still you can file a lower deduction certificate with the income tax department. It's a procedural side, but there is, yes, there is a possibility so that NRI can still reduce the TDS rate from 30% to lower rates. Now, very important transactions, which is a property, either a purchase or a sale, which is something a very frequently NRI does. I'll just explain how the TDS function in a property sale. On a property sale, you always have a doubtful what rates of TDS should applicable, either a 1% or a 12.5%. It's actually 12.5%. 1% TDS rates will come only when resident is the seller. When a non-resident is the seller, it is 12.5%. Now the second question, on what I apply this 12.5%? It's on the sale value or on the capital gain. It's always be on the capital gain, not on the sale value. Now the second question comes, who determine the amount of capital gain? What is capital gain? If you sell any long-term capital asset, property is a long-term capital asset. If you sell, sale minus you reduce the cost of that particular property, the resulting value is profit. That profit we call as a capital gain. If the resulting value is a loss, we call as a capital loss. Now the question, who determined the amount of capital gain? Buyer or a seller? None. It's always been income tax department. Not buyer, not seller, only income tax department can determine the capital gain profit involved in a property sale transaction. For that, you need to approach income tax department to file a lower deduction certificate. In the absence of application, I repeat, in the absence of application, the 12.5% TDS shall apply on the whole sale value. That means if you are selling a property for 2 crore, assume the profit is only 50 lakhs. If you don't apply the lower deduction certificate with the income tax department, then technically the 12.5% TDS rate shall apply on the entire sale value. That is the law. So, as I explained, if you apply, say for example, sale value of a 2 crore, long-term capital gain is 15 lakhs. If you would have applied the lower deduction certificate, you would have earned a 6.25 lakhs is actually the tax liable TDS rate. But if you don't apply, the entire 2 crore will be subject to 12.5%. The total TDS become a 25 lakhs. This is a part. So recent change in income tax on the property sale. This is something very, very interesting, and I personally involved in this particular transaction. So assume if you bought a property and if you sold the property before 23rd July 2024, the 20% was the tax with the indexation. What is indexation? As you all know, there is an inflation in the country. So giving the benefit of inflation, there is something called cost of inflation index. Always you can apply a cost of inflation index on the purchase cost so that you can bring the cost to today's market value, giving the benefit of indexation. So, but unfortunately, 2024 budget, they have removed the indexation benefit. It was a big issue at that time when the budget was came. Later, finance minister changed the budget, changed the bill. They said, okay, no problem. We will give you the benefit of indexation with 20%. Without indexation, 12.5%. You can always do a comparative analysis. Whichever is more suitable, you can take that benefit. But unfortunately, when the law came, this benefit was not extended to NRIs. It was only available for resident. That was very unfair. But as of now, the indexation benefit is not available for NRI. Now let's see how this might have affected your property. Just give you a picture how it works in Kerala. Assume, and just closely monitor the transaction. Assume you bought a property in 2001 and 2, that particular period. When you were bought, it was 50 lakhs value. Today, if you are selling it for 1.5 crore, that was a transaction. Since you bought the property in 2001 was for 50 lakhs, apply cost of inflation index. Today, the purchase cost for income tax purpose, indexed cost for that particular same property, actually 1.82 crore. That means it's actually a long-term capital loss of 31.5 lakhs, and you are not supposed to pay tax because it was a loss. That was the previous law. Extend another 10 more years. Assume you had bought the property in 2010, 75 lakh rupees. Today's indexed cost of acquisition is 1.63 crore. Again, if you're selling the same property for 1.5, you have at a loss of 13 lakhs. Another scenario, if you see, you bought the property in 2015 for 1 crore, indexed cost is 1.51 crore. Again, you have a loss scenario of 1.25. All these three scenario, there is no tax payable. It because you're resulted into a long-term capital loss because of the indexed cost of acquisition. But considering the new law, not a new law, it's already in that's a current law. The same transaction you end up in paying the first scenario 12.5 lakhs, second scenario 9.38 lakhs, third scenario 6.25 lakhs because of this change in the law. So that's a really impact NRI when he wants to sell a property. I will tell you, this is something really impactful only. You have a property like flat and villa type of transactions. But land anyway, hardly won't be a much of cost wise, may not shown in those value as it is on the paper. That's unfortunately with the land part. So this is a loss scenario. So we as a firm, we put a lot of effort in last 6-7 months on this particular matter. We raised voice for NRI on this particular issue. We filed a writ in the Kerala High Court on 8th October 2024, which was admitted. Almost for information, it's almost 8 times the hearing has been called for. So far, there is no response from the other end, but still the case is still open in the Kerala High Court. We've been connected with so many NRI associations across the world, and we were represented, and maybe we asked them to represent to the finance minister. It was very much support from most of the association side. We've done a lot of news coverage and radio coverage in the Middle East region to raise this voice. And we've been, I would really thankful to almost 8 MPs from our state, Kerala. They are really been taken it up on personal level because I've been personally involved in these matters. I think they were very, very serious and they gave full support. But unfortunately, still the 2025 budget was approved. There is no change in the law, but still I have hope in the court there could be some change. And definitely we just keep on highlight this particular matter before the government on behalf of the NRI community. Any members who is attending in this particular webinar who represent any associations, please do touch with us so we can still discuss and take it forward. And we can also showcase your voice also before the government. So again, the very, very important, very common. I just want to keep it last. It's a common question. How many what type of bank accounts the NRI can maintain? Just want to highlight, can maintain NRO account, non-resident ordinary account, non-resident external account, foreign currency, non-resident FCNR account. These are the three types of bank accounts NRI can maintain. NRI shall not maintain any resident savings account because nothing to do with income tax law. Just want to highlight your NRI status today you enjoy. It's nothing to do with income tax law. It comes under FEMA, Foreign Exchange Management Act 1999, which comes under the governed under the RBI. And since you hold the capacity as a NRI, that is a reason you are allowed to operate these types of bank accounts in the country. That means you are not supposed to maintain, operate resident savings account in India. Okay, so this is a FEMA penalty, but I don't want to highlight. There is a 3 times of the amount involved is the penalty. 5,000 rupees per day from the day of default until penalty is paid is also penalty. But we are not seeing such. Actually, FEMA is getting into such kind of scenario. But highlight, always intimate to your bank. Whoever is maintaining your SB account, you can always inform them to convert that to NRO account. That's not rocket science. Your existing SB account is actually your NRO account only. From the bank account, they actually will keep your KYC as NRI capacity. So with this, we can close the session and we can open for a Q&A. You can take the contact number from office. Anyone you want to any service from PravasiTax to file IT return or any succession planning or a will, please do contact office and we can help you to support. Thank you so much, and we can take the Q&A. Thank you.
That was indeed an insightful and highly informative session by Sreejith sir. Thank you so much. We now open the floor for questions. If you have any queries, please type them in the chat box, Manas sir. I'm sure our expert, Mr. Kuniyil, will be happy to address them. Our inbox is already flooded with several queries, and due to time constraints, we are handpicking a few. You can still type your questions or queries in the inbox. First question is, Can you please brief regarding RNOR status and RFC accounts?
RNOR status? Okay. Okay. So
The
there
customer.
are, I understood, but I didn't cover that slide here. There are resident have a three different capacity. One is a resident but ordinary resident. We call as an resident but ordinary resident, and resident but not ordinary resident. The moment assume, for example, if the NRI is right now he's not residing in India. The moment he is back in India and he stay more than 182 days, then he become a resident. There are other conditions also there that that particular individual, assume he stay more than 2 years in India, then technically he considered as a resident but not ordinary resident. That's the RNOR status. During RNOR status, advantage if any individual NRI or a RNOR status holding individual is resident foreign currency account. Resident foreign currency account is tax free. That is an advantage what he is just referring. During the RNOR status, RFC account interest is tax free. The moment he become an ordinary resident, your RFC account interest is become a taxable income. This advantage benefit is only available for a RFC account, not for NRE account. The moment even he become a RNOR, your NRE account interest is taxable. This hope it is clear.
Thank you, sir. Next question. The tax slab of the TDS slab of 25,000, is it a per year slab? Does it include
Yeah.
the interest earned on the NRO account?
Per year. For example, if any individual who earn interest income of 1 lakh rupees, technically there will be a TDS of 30,000 rupees. That individual is supposed to file IT return mandatory, and also once he file IT return, he get refund also. Am I clear? Hello?
Yes,
Hello?
sir, you are.
Yeah.
Yes, sir. Yes, sir, you're audible. Next question. If income tax return is not filed for last 2 years, what will be the consequences?
Okay. So consequences, please go to your income tax portal, get the login details. It's very simple. In case if you have any challenge to get the login details, please do contact office. Gina can help you on this particular email ID. So once you go to the portal, please go to the e-campaign query. Just check, is there any transaction has been reported under your name, e-campaign query. Or otherwise, you can check, is there any e-verification notice was served to your name. If there is no consequences or there is no transaction being reported, fair, you can leave it. Otherwise, not much of consequence. Consequences is what? So your previous transaction was reported and they see you didn't file IT return, they may proceed to start other initiatives.
Next question. Is if there is an interest income in NRO account and if the TDS is about 25,000 per year, should IT return to be filed?
Yes, it is mandatory. Mandatory.
Next question. While the country encourages investments, what is the logic behind restricting NRIs in certain investment instruments like sovereign gold bond, gold ETF, digital gold, government bonds, PPF, KVF, agri land, etc.?
Still, I'm also searching for that question. Okay. I don't have an answer. I will tell you. Be frank with them. I always look for that logic why government is restricting on the agricultural land, real estate transactions. Not only that, so many areas NRI has been restricted in terms of investments under FEMA. Logic I am also, because otherwise if you see every investments by an NRI at par with a domestic investment, considered at par with the resident investment. Few things why government restrict because see FEMA is a I would say that it was earlier before 1990 it was a FERA. Later it was converted into FEMA. But if you see from the last my 25 years of my consulting, the one I was reading in during 1999, I also started my career in 1999. But I would tell you, significant, unbelievably significant changes happen in the country in terms of FEMA. Every 3-4 years, you can see the developments happening in the country. They liberalized so many sectors and opened so many sectors and increased so many sectors. So I think as part of the liberalizations, the kind of economy is growing. Government is also growing. Earlier, so many restrictions were NRIs had, but today not much. But still, few sectors been restricted. But I think there might be a reconsideration. It may relook into it definitely because government is always change laws according to the economy, economic to the development. We can expect some, but logic even I don't know. I'm sorry to say that.
Next question. When an NRI becomes a resident, does indexation benefit is available for the property he bought when he
Yes,
was an NRI?
yes, yes,
If an
yes.
NRI transfers his property to his children through a gift deed, does capital gain tax is applicable?
No, gift is tax free between relatives, blood.
Okay, sir.
Yeah.
Now the next question is the residence is in Oman. How to clarify double tax avoidance benefits, especially for LTCG on shares?
LTCG on shares.
Yeah.
There's no benefit actually. In fact, there's not benefit.
If an NRI is an OCI, that is overseas citizenship status, is it possible to maintain a regular savings account or FD without penalty?
Okay. So, okay. It's a good question. Yes. First of all, there are certain things shall not be allowed to operate or maintain, and it is a shall means is a mandatory, and every mandatory conditions always it come with penalty. Otherwise, it's not mandatory. Anything people give an option without penalty, nobody will follow. So the law always come with penalty. The reason you need to follow the law. That's the reason penalty comes to the picture. So if anything, otherwise it become an option. It's not an option.
Okay, sir. Our inbox is still flooded with questions, but due to time constraints, you can either raise your queries to South Indian Bank NRI cell, or you may please reach out to Kuniyil sir for further clarifications. As we wrap up today's session, I would like to extend my heartfelt